The market did something really unusual. It made an all-time high in February, and that is really weird because February is the month with the third least amount of all-time highs. So what normally happens when that occurs? Today, we discuss that and CPI revisions. Tomorrow, the Fed will revise their CPI prints for the past year, as well as change the core components of CPI. So could this trigger a volatility event? Let's talk about it. Hello, ladies and gentlemen. Welcome to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. We do these videos every single day. So if you like this video, hit that subscribe button, like this video, hit that notification bell. Let's get into it. A very mixed day of trade today, half and half across the board. I'll give you an example. Let's look at technology, right? Nvidia, Microsoft, Apple, they didn't participate, but there were tech names that did perform. We're looking at software technology. Some of these semi names right here, they really did hold tech together. And I think we're starting to see multiple expansion in these software names. I was actually buying an ETF in the mid-cap software sector at the start of January for the first 1 to 5 days. I was loading the boat in software names and it's really starting to pay dividends now, just even 6 weeks on. But again, look at comm services, Google, Meta. They sort of didn't participate. They kind of did. The rest of telecoms didn't. Look at defensives, half and half. People buying Pepsi into earnings. Same with healthcare. What did perform the best though was energy and real estate. They did a pretty good job, especially energy with what's going on with crude. But we saw stuff like financials, utilities, basic materials, pretty rough go of it. But looking at breadth in the S&P 500, half and half, about 255 winners, about 245 losers. The thing is, when you don't have the mega caps participate, you kind of just get a flat S&P 500. And that's exactly what we saw. The SPX was pretty much flat on the day. The Nasdaq marginally up, as well as the RSP beating both of them. The real winners though, small caps, mid caps. TLT down, bonds down on the day despite a fantastic bond auction. And that's why we saw a lift right here and then a continued rally towards the end of the session. But bonds still negative on the day. I think mostly because of CPI concerns and what that's going to look like. We get CPI revisions tomorrow and there's some word on the street about how it's going to infect goods and goods inflation. So I think traders are just cautious about what's going on right there. Now, looking at sectors on the day, this right here is the 30-year bond auction, guys. The biggest winner, as always, semis, software. In second place, though, energy. Crude was up 3%. There's quite a bit of Middle East tension. Crude rose, so energy stocks rose. And we're in an energy trade right now, guys, and it's been very fruitful, especially with where I got in. I pretty much got in at the bottom of energy in January, and it's been really great. That trade is up 5 to 7%, and I do think that energy is going to be a huge winner this year and next year because we've started to see energy earnings turn up. You know, the 2025 energy earnings was negative 4%. It's now being revised to plus 7%. For energy. I was actually looking at Oxy's earnings expectations. They were negative 1% a month ago. They now expect to return plus 9% for 2025. I do think that energy, in 2024, is a place you want to be in because we're going to see oil increase. We're going to see demand in 2025 increase. And I think buying energy stocks at a 9 PE right now, after we get huge earnings upgrades and multiple expansion, is really going to bode well for the market. But I digress. Other winners today, real estate, discretionary, regional banks, technology, two metals and mining, comm services, they all outperformed the SPY. The SPY is sort of the baseline. Below the SPY, we had industrials, staples. Industrials still positive on the day, pretty much flat. But the real theme we saw here was that these cyclical and sensitive sectors performed really well. And then sort of healthcare, defensives, financials, GDX, XLU. I mean, that's a sensitive sector, but just these defensive names not performing the best on the day. However, have a look at utilities from about here all the way up. Huge rally. So there's definitely some defensive positioning into tomorrow's CPI revisions, and I'm going to talk about them tomorrow when they release. Now, looking at the best sectors over the last 5 days, and it's very similar to what we saw today. I mean, semis, comm services, software, they're the best performing sectors. And really, if you actually have a look at these 5 sectors, it's really just the mega cap sectors. We're looking at Nvidia, Meta, Google, Amazon, Tesla, Apple, Microsoft. So the mega cap trade continues to be the strongest trade this week and so far for this year. But that being said, we're seeing bullish momentum in energy, industrials, healthcare too. And that's because earnings are turning up. We're coming out of that manufacturing recession. We're seeing the tensions not ease in the Middle East, but the price of oil is reflecting what's going on there. And the worst performing sectors over the last 3 days definitely see it's real estate and regional banks, sort of these like highly sensitive, rate sensitive names like GDX, like utilities. They got a lot of debt on their balance sheets. They're not doing the best because yields have risen quite a lot. And even after a fantastic 30-year bond auction, yields still did what they did. Yeah, a bit of stress on those companies with a lot of debt and who have poor balance sheets, whereas those who don't, you're being paid to hold high quality businesses. The market is paying you to hold those in outsized returns. And why wouldn't you if you're going to hold a high quality business versus something that's not quite as high quality? Now we got the latest AA sentiment survey, and we're still sitting at these extremely bullish levels in regards to bullish sentiment votes. But what we are seeing is one by one, the bears are being defeated and being converted either into the neutral zone or towards the bullish zone. Either way, sentiment is still very, very bullish and a lack of bearishness in the sentiment as well. And we can definitely see people are capitulating either towards the middle here or towards the bullish side, because bullishness is still very elevated and we're well above the historical averages, as you guys can clearly see in all regards. Now looking at NAM exposure, so over the last couple of days I've been showing you guys a ton of breadth thrusts and we're keeping up with the trend. We're not stopping. This is the S&P 500 returns when there's a 20-day breadth thrust. So all this is just, I believe, 80% or 70%, something like that, of constituents above the 20-day moving average. What are the returns we can expect? Anywhere from 5 days to 1 year out in the S&P 500. And on average, even just 5 days out, you can expect a 1.3% return, 10 days out, 1.8%. And really, 1 year out, you're looking at average gains of 17%. Now, that might seem unrealistic, but I've seen crazier stats when it comes to stuff like breadth. Median returns, though, 12 months on, 15.8%. We look at 6 months on, it's 9.7%, 82.8% of the time positive, 96.6% of the time positive 1 year later. And have a look at the max gain right here, 42.7%, but also have a look at the minimum. So the risk to reward right there is something like 1 risk to 1.5 reward. So the risk to reward is not quite there. But that being said, with the way markets are skewed to the upside and geared to the upside, you're definitely better on the long side than the short side. Now, this is the S&P 500 in a 20-day breadth thrust regime. And you can see that right here, we were in a breadth thrust regime right here and right here. And we started a new breadth thrust regime sort of around the December area last year. You can see that these can go on for months, sometimes even years at a time. So it pays to be on the long side when you see longer term indicators like these. Now let's talk earnings, guys. The reason why I talk about earnings so much is because it is the number one fundamental driver of growth and price action in the market right now, along with options, and that's why we cover gamma and earnings so extensively. So the S&P 500 8.1% blended earnings growth rate. This data from the 6th of February, and this is what this means, right? Every company that has reported so far and every company that's yet to report so far and their expected earnings, they sort of blended together. This is what we're getting in the S&P 500 for 2023 Q4, 8.1%. Excluding energy, we're looking at 11.5% earnings growth right now. And energy is really, really letting us down. And here's the thing with energy, right? In terms of weight in the S&P 500, its weight is only about 4.9%, but its earnings weight is very, very high. In fact, the energy sector produces as much revenue as the tech sector, in case you didn't know.
And if you don't know, now you know.
And that's why if energy earnings is negative, it can really weigh down the index. That being said, excluding energy, double-digit growth, not just double-digit growth, deep into double-digit growth, 8.1% at the index level, very positive stats right here. And we can also see the same for mid caps and small caps. Exhibit 48 of BofA Research says revision trends improved across the board this past month, the weakest in small caps. However, we can see that revisions are turning to the upside in large caps, mid caps, and small caps. Even though small caps were the weakest, we are seeing a trend change in revisions, and this is actually what we want to see. And you have to remember, just last week or or just 2 weeks ago, we were looking at negative 7.1% earnings growth for the S&P 500. We're now sitting at a blended earnings growth rate of 8.1%. So the revisions are definitely happening, and we really have to see where these go for the rest of 2024, 2025. Now let's talk yields, guys. This is the 10-year yield, and we're sitting at this level right here, at this 4% level after the 10-year yield. The 10-year bond auction yesterday didn't do much of anything, but this is where we are sitting right now. And the normal seasonal trend for the 10-year yield during January, February, and even into March is that we normally march higher quite significantly. Then we sort of consolidate all the way up until about the start of April, and then we actually trend lower. So if we actually go back to the 10-year yield chart, you can see that's actually what we've done for this year so far. Now, it's not an exact science. We have marched higher, did come back down, of course, but we're back up at this level right here. And we're actually kind of following seasonality. And if yields do go a little bit higher into March, into April, and then we consolidate maybe even above the 4.184%, that would actually be in line with typical seasonality according to what Bofa Research has right here. And if we actually look at the average trend since 1963 to 2023, we can see much of the same. We actually increase all the way into the May-June area, and then we decrease into the October, November, December area. Now this blue line right here represents the average trend when January is up in a presidential cycle year 4, which is what we're tracking right now. And then this blue line right here, this dark blue line, is actually just the average trend. So according to seasonality, the 10-year yield is doing exactly what it normally does based on history. And if we actually have a look at what BOFA expects fair value of the 10-year yield to be, this is their forecast. This is their adjusted model. So this blue line is fair value for the 10-year yield. This dark blue line is the 10-year yield. And this is where they forecast the end of 2024, the 10-year yield to be. So that being said, what is this all telling us? That most of the pain we've seen in rates moving higher is probably behind us. Now, this is all speculation and it's a forecast, but normally forecasts have some weight to them, and Bofa Research do a really good job. And with rate cuts on the table, we can actually expect the 10-year yield to be at or even below this by the fourth quarter 2024. Now let's talk employment. We got jobless claims data. In light of that, we can also see here that challenger job cuts versus pre-COVID monthly average. Now challenger job cuts have actually been increasing and spiking, and as a whole they've been fairly high for most of 2023, 2024. A lot of the work that was retained after the COVID situation is now coming to roost in the face of job cuts. But if you look at this data entirely, it looks very negative, like, oh my god, employment is on the rise. But that is not actually the case, because if you actually look at broad employment gains across industries, and this is losses too, because you can see here that mining and logging lost 6,000 jobs. Since the start of 2024, we've actually gained jobs, the most in healthcare, social assistance, professional and business services, retail trade, and then government, only number 4. The way people go on Twitter that it's all government jobs, it's simply not the case. And we actually are seeing jobs being put into the economy, even though we are getting a ton of layoffs. As well as we got the JOLTS numbers last week, job openings are also increasing. So the economy is hanging in there with jobs, and we're actually in a very, very strong position when it comes to employment. And we can definitely see this on this chart right here. This is the present situation index, jobs plentiful, jobs hard to get. And we can see plentiful jobs are actually increasing, and jobs being hard to get is actually decreasing. And we can actually see that employment conditions is also increasing on this bottom chart right here. And these periods right here being recessionary periods. And right now, across all of these indices, we're tracking better than the pre-pandemic trends. So the United States employment situation is in a really, really good position. And furthermore, the thing that is driving layoffs is not actually a demand issue. It's actually just cost cutting, as you can see from this data right here. Now, with a strong labor market comes a strong consumer. And I don't really trust government consumer data. What I really like to look at is what companies are providing. And something I look at every single month is Costco's wholesale reports. So they release their sales report every single month. And based on this data right here, we can see that Costco reported net sales of 22.08 billion for the retail month of January. The first 5 weeks ended February 4th, 2024, and it was a 4.5% increase from last year. So the consumer's hanging in there. Costco sales are increasing greater than what inflation is, at least the 6-month annualized inflation. And this just shows the consumer is strong and hanging in there. Further to add to that, what we're also seeing is that total intermodal units in US rail traffic as well as total traffic versus 2023 is actually increasing 10.1% in intermodal units and total traffic 0.7%. Now looking at other stocks besides Costco, we look at stocks like CRH, CSX, CX, PCAR. These are building materials, cement, rails, and trucking. We're seeing all of these stocks at new highs, and this is a very, very bullish sign. If stocks were not making new highs, if earnings were not good, that would mean the economy is not good and people are simply not using building materials or cement or rail traffic or trucking at all. And this is extremely bullish when you look at it. Adding on to this, the Fed's GDP now, which was at 4.2%, and I did say in the week earlier that that's looking a bit hot if we go into the economy, but the Fed's GDP now is sitting at 3.4%, and it is cooling, and I would actually like it to come down to like the in between the 2 to 3% mark. That would be really good because high GDP can really reignite inflation and keep the economy hot as hell, and that's going to push yields further down the track. And we already know we were expecting March, it's now looking like May, June. Now let's talk seasonality. Now I got some data for you guys here. This is the S&P 500 forward returns after making a new all-time high in February. So pretty much when we make a new all-time high, what are the returns? And it's pretty brutal 1, 2, 3, and 4 months later. It does improve a little bit 4 months later, but the first 3 months after February, so being like March, April, May, sort of in this period right here, can be pretty brutal. I mean, especially 1 month later. Generally speaking, this period here should be used as a dip buying opportunity for the returns we can expect, because 12 months later, we're looking at average returns 15%, median 14.8%, minimum negative 8.19, maximum 32. So the risk to reward there is like 1 to 3, 1 to 4, 87% of the time higher. So again, we're looking for this dip in Q1, Q2 based on seasonality to go long for the rest of the year. And we do know that based on seasonality, anywhere in Q1, Q2, based on the 4th year of the presidential cycle, we can expect some form of a dip, which is to be bought for outsized returns in the second half of the year in a 4th year of a presidential cycle. But looking at February more specifically, you can actually see that we are sort of diverging away from the average seasonal trend in the S&P 500. That being said, the higher we go, I'm not complaining. That's just more gains for the bulls. Now, normally we do expect some form of a dip to occur around this time before we make a run up into OPEX. This right here is normally OPEX, and then we do expect some selling towards the end of February into March. And normally we actually finish February on a negative note. Now let's talk gamma. Now 5,000 right here continues to be the call gamma resistance. Now do expect this to act as resistance if we go up and touch it, but if we get above the 5,000 strike and come down into it, expect it to also act as very strong support. Now there's not much to say. There's virtually no bears on this tape. Quite a lot of bulls building up positions right here. I have no idea why, and the 5,100 continues to build out, but there's a lot of gamma building in the tape. Just yesterday it was at 1.5 billion, and if you don't know what these numbers mean, this is essentially how much gamma hedging needs to take place per 1% move in the S&P 500. So for example, if the S&P 500 moves up 1% in positive gamma, at the 5,000 strike, dealers will have to hedge $2 billion worth of SPX futures. That's essentially what that means. Now, one thing that we have to really start looking out for next week is where this gamma strike is going to get rolled up to, because we have a very big OPEX in March. It's a quarterly OPEX. If this gets rolled up to the 5,100 strike, that's definitely going to be our next target looking at March OPEX. But if it stays at 5,000, that means bulls don't see any value in higher price discovery. We also have to see if we do sell after OPEX into Feb once the window of weakness opens. So there's a lot at play currently, guys, but the main thing we're looking for is if the index sells, and if it does, where does this positive gamma node position itself? At 4,900, at 5,100. Those are the questions that we really want answers to in the next week. So this is the S&P 500, the SPX, guys. And one thing we are seeing is that the advanced decline line is actually confirming the price action we're seeing right now. If we actually zoom in, you can see that we're sitting just above the previous highs in the advanced decline line right here. And again, making highs in the S&P 500. It's not an exact science. The breakout, I guess you could call it, what we're seeing in the S&P 500 right here is somewhat being confirmed by the ADL line right there. Looking at actual price action, and yeah, bears thought we were going to reject heavily on this 5,000 level, this high gamma resistance. Bears thought we were going to go down. Bulls thought we were probably going to break above it. What the market said we were going to do is just trade flat across it. And the truth of the matter is there's just so much gamma at 5,000, like I showed you on the gamma chart, that it's going to be really, really hard to break above that even next week until a lot of that gamma gets rolled off. But I will say this, if we do go ahead and break above that 5,000 level, that 5,000 level is going to be a very strong support zone. That being said, this chart's still looking very strong, looking very healthy. I said at the start of the week that until we broke this, I wasn't looking at any weakness in the index. We have not broken it. And the trend right now is still up, and we just don't want to fight the trend. But looking at actual trade on the day, where did we open? We opened somewhere like here. We just pretty much traded flat all day. It was some of the craziest and weirdest trade you would actually see. Something to note, guys, is that government bonds, they're only up 0.06%, as you can see here, but this is after hours, so they're up ever so slightly, especially the 10-year and the 20-year on a day where they were up like half a percentage point, at least in the 10-year as well. So yeah, it was up like half a percentage point as well. So, a bit of movement in yields. It's actually bear steepening what we're seeing. So we're seeing yields uninvert ever so slightly, with the yield actually moving in the upward direction. And that's called bear steepening. It's bearish for bonds because bonds fall as a result. It means one of two things. It means yield is increasing because inflation is increasing, or yields is increasing because there's a strong economic backdrop. We do know that inflation is decreasing and the economy is very strong. So we're sitting in the number 2 camp. That's really, really good. That's an indication of a strong economy. Many people think you have to have low rates for a strong economy. Actually, if you have a strong economy and high rates, that just highlights the strength of your economy. Now, I also think the reason why we're seeing this move in rates has to do with CPI revisions tomorrow. The market doesn't know what to expect. And when the market doesn't know what to expect, it tries to discount it as effectively as possible. And it's normally going to go in the risk averse trade versus the risk on trade. And I think that's why we're seeing some of the defensive names get a bid towards the end of the day. Have a look at utilities. You can see right here at the bottom on the day, a big wick on utilities. So a lot of people were like buying this. Maybe they also see value at that level, but then we go ahead to healthcare. Very similar situation. Have a look at the wick right there. A lot of buyers came in at the end of the day. Still red on the day. So we could see the market getting a bit defensive with the CPI revisions coming in tomorrow. But there's always like context and other things going on in the market under the hood. Now, but looking at RTY, this chart is screaming indecision. We're making higher lows, lower highs. It's just like here. What does the market want to do? And I think we're looking for a breakout in either direction here for small caps. And it's a very similar situation for mid caps, but looking a lot stronger. I think what mid caps are going to go attempt to do is break above this section right here and go and attempt to break above the 28-25 level. And if you ask me, that doesn't look super strong, but it just doesn't look weak either. I just think we're probably going to go try and test a breakout to the upside. And we do know that the mid cap earnings is significantly better than what small cap is doing right now. Looking at the RSP, and again, similar situation to mid caps, we're sort of testing these highs right here. But what I really want to see RSP do is just go and break out, huge breakout, just to confirm that. And then we can see a massive rally all the way to the 164 area, which is new all-time highs for the RSP. Now, this is an indicator I use a lot, guys. It's the Fed liquidity indicator. Pretty much what we can see is that, when liquidity is being injected into the market normally rallies. What we have seen is that liquidity has actually been decreasing since about this period right here, yet the market has been rallying. So there's a bit of divergence there, but that could be a good thing, because if we do get this liquidity boost into the market, we could then actually see even further higher price action. That being said, do take into consideration that net liquidity from central banks is actually decreasing, especially by the Federal Reserve. So data for tomorrow, we just got CPI revisions, and pretty much all this is that the Fed's going to revise a bunch of CPI prints, particularly in goods, and that could alter the 2% inflation number we're currently seeing. Inflation right now is 2% on a 6-month annualized basis. So this could be a very big deal, or it could mean nothing at all, but I'm going to cover it all tomorrow. And I think that's why we saw a lot of defensive positioning towards the end of day, and why we have seen yields rise quite a bit. So this is a big deal in light of the fact that we do get the CPI print next week, Tuesday. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, and like this video. Cheers.